Hi everyone, this is Demo Gonzalez of Heartwood Financial Services. Thanks again for tuning in to another market update and outlook. We got a jam-packed presentation for you today. As you all know, there's been a lot of headlines about coronavirus. So we're going to talk a little bit more about that and how it's affecting the markets and my outlook for the next several months. And also I got a new beard, so hopefully that's not too distracting. Trying something new there. But thanks again for tuning in and enjoy. So as always, I like to start with the asset class returns for the month. This is ending the month of February. We start with large caps. We have the month to date and also year to date. And as you can see on the large caps, it's pretty much the same. That's because most of the losses that we saw for the month of February, which really just happened in the last week or so, has been really all the losses for the year. So down about 8.23 for the year. Small caps did a little bit worse, down about 9.6% and down a little bit more for the year. And then you have real estate that's held up a little bit better. It was actually doing pretty well, kind of fell apart there a little bit at the end, just like everything else in the last week or so. February down 6.3. International down 8.97. That's the developed markets, down a little bit more for the year. Same thing with emerging markets, down 5%, down 9 for the year. Although it's interesting, you could see emerging markets actually didn't go down quite as much as the large caps, small caps, and even real estate. So that was an interesting development. And then we have the fixed income. That's actually up. So we had fixed income up about 1% for the month, up 2.68% for the year, and high yield kind of flat and up a little bit for the year. And of course, the last one is commodities. Again, that is all the different commodities, including gold and oil in particular has been the negative one. In fact, today we see oil down quite a bit as well. So that's going to continue on, unfortunately. But down 5 and about 12 for the year. But as you can see from this, this is why it's important to have that diversification. The fixed income portion of the portfolio has been holding up much better. You folks are certainly not down as much as you see in the equity indices, because we are all using an asset allocation approach that has some sort of fixed income exposure. So it's really been basically like the cushion or the shock absorber for our car here. So that's the update on the markets and the returns. The next I'll have more of some of the latest headlines and what's going on. So here are some of the latest things that have been going on for your market update. First of all, I must throw out a disclosure. I am not an epidemiologist. I am just an observer of the markets and the economy and where the valuations on things are. So I'm going to be making commentary on that. So take that into consideration, of course. But coronavirus continues to be on the headlines. The fears persist. And so the big change of what happened last month to this month is the spread is starting to go outside of China. Obviously, you've been seeing a lot of this in the news. And this has been causing a global correction so far. So anytime you have the market down more than 10%, it's called a correction. And so since the highs, the market is down about 13, 14%, unfortunately. And if it goes to 20%, that's what's considered a bear market. And we're going to talk a little bit more about that at the end, what some of those might look like. The numbers are growing. We're at about 100,000 that are affected. Unfortunately, 3,300 or so deaths. It still sounds kind of like a high mortality rate, higher than what you'd find in things like, like a regular flu. But I think those are still a little skewed because obviously the people that are sick are the ones that go and go to the hospital. They get counted, and sometimes the people that are not too sick are the ones that don't get always counted in these types of stats. So the mortality rate is still pretty high though. So I'm not trying to belittle that point, but when you see 3%, it sounds kind of scary. It's probably more in the 1% range. The COVID, COVID-19, which is what it's being called now, is definitely slowing down economic growth. And the expectations are for at least this first quarter of this year to have a pretty major slowdown globally. And depending on how long it lasts, which of course nobody really knows exactly how long it will last, it could start even having an effect on Q2 and maybe even Q3 in some of the worst case scenarios. Of course, my base case scenario is more of a big impact for Q1, maybe a small impact for Q2, and things will hopefully start getting back to normal here pretty quick. If you saw my letter that I sent out a couple weeks ago, the summertime does tend to be a time frame for flu-like viruses to start to slow down. So, I'm hoping a little bit that continues with this one as well. But of course, this could be completely different. Again, this is where I'm not an epidemiologist. I'm only making observations. But hopefully that will be the case. Last couple things. The Fed surprises the market by lowering the Fed funds rate by 50 basis points. It was a pretty big surprise because they usually do these types of changes at their monthly meeting. They don't actually meet for another couple weeks, so this was kind of like an emergency one. I think it spooked people a little bit, which is why the market went down that day. But the day after, it was a pretty big day. It was also Super Tuesday, which, that might have had some effects of it as well. But the Fed is trying to do everything it can. Of course, they can't make vaccines be created quicker by lowering interest rates. But the big concern is the economic repercussions of, quarantining people and not traveling, and people maybe being a little nervous about taking vacations or going to restaurants and things like that. So they're trying to ease that fear a little bit by lowering interest rates. And we'll talk a little bit more here in a minute, but what it's done, it's created a super low interest rate environment. The 10-year Treasury rate as of this recording is at a record low. Last time I looked, we were at about 0.75 of 1%. So can you imagine the U.S. government can borrow money from you for 10 years and only pay you 0.75% for 10 years. That's pretty amazing. So that does really kind of change the dynamics a lot of stocks versus bonds, and we'll be talking more about that as well. But that's the latest on what's going on here with the market. Here's a quick chart I found here from the New York Times. I thought was a pretty good chart to share here. As you can see here, it's the coronavirus. We still don't know exactly how fatal or how contagious it is, so they got kind of a range that they choose here with this colored rectangle. But the main points that I wanted to make is that it looks like it's a little bit more contagious than the seasonal flu, and a little bit more deadly than the seasonal flu. But as we talked about last month, compared to SARS and Ebola and the bird flu and some of these others, that we saw some pretty nice bounce backs from the market after 6 months. It appears to be a little bit less deadly and similar in the range of being contagious. So that's why you're seeing, of course, a lot of people shutting travel down in certain areas and quarantining and things like that to hopefully stop the growth of the infections. So I don't want to, make it sound like it's not a big deal. It is, and hopefully it won't get too much worse. But at the same time, it is definitely not as bad as some of the types of viruses we've had in the past. It seems to look like. So I briefly mentioned earlier the record low 10-year yield at the 0.75 range. This is a little chart that shows the history over the last several years. You can see this is the lowest rate we've ever seen. Pretty good if you want to refinance your house potentially. You should definitely check that out. You're seeing 30-year, 15-year mortgages in the low 3 range. But there's good and bad with this chart. One way you could look at it is you could say there's a lot of fear. The fear is really bad, not just here in the U.S., but globally, because the Treasury market is purchased by people not just in the U.S., but around the globe. So that is one way to look at it that's a little bit scary. The other way you can look at it too is you also have a backdrop where it is going to be very cheap to borrow money. The opportunity costs of going to stocks versus bonds grow greater and greater because now you're getting to the point where the S&P 500 is yielding about 1.9%, and you got the 10-year and even the 30-year Treasury that's paying less than that. And so historically, those have been very opportunistic times to buy stocks. Obviously, it's hard to say what's going to happen in the short term, but those are good long-term indicators of value in stocks versus bonds. Pretty interesting. Okay, so here's the outlook for the next few months and kind of the summary of my observations here. First of all, until the coronavirus growth peaks, volatility is going to continue. And again, nobody knows exactly how long that's going to be. A lot of forecasters are saying summer is going to get a little bit better, but again, that would be assuming that it's like all the other viruses, influenza type viruses. So we'll hope that that happens, but again, we have to play it a little safe because the contagious factor of this is pretty high, and it does have a mortality rate, especially for older folks, that's a little scary. So that's going to continue. We're going to probably see another month or so of the volatility we've been witnessing here over the last couple of weeks. But on the positive side, China seems to be showing signs of stabilization. Again, they're the ones that started all this, remember? What's happening is the growth of the infections has been slowing down. Their stock market actually over the last week or so has actually been doing better. As you saw a moment ago, I was talking about emerging markets and how for the month they've done better. That's because they did worse in January, but it is maybe a little precursor to what could be happening here. Of course, the argument is China can do a lot of things that we can't do by basically shutting down cities and all kinds of things. But then I can make the counter argument that China was hit by this at the very beginning without really knowing much about the virus or having really much to work with as far as therapeutics and potential strategies of how to contain it. And so I think we have an advantage certainly here in the United States because of some of the experiences China and Korea have had. Also, you have valuations for stocks that are a lot more attractive, especially relative to bonds. I'll talk more about that in my my detail segment when I get into the math of the market. But I see the stock market becoming a lot more attractive, especially when you got bonds paying less than 1% on the treasuries. So we'll be, look for some changes to come there. The other thing is sentiment indicators are showing signs of bottoming. I'll show you the chart on this one here in a second, but you're having a lot of negativity, and usually when the negativity gets this low, it's usually a good sign. It's a contrarian sign. One of the ones that I'm looking at is the Fear and Greed Index, and I'll show you more on that one in a minute. But it's about as low as it was back in the December of 2018, right, when the market bottomed last time. So that could be a promising sign. We'll have to see. And then as far as expectations for the market, I was hoping for more of a V-shaped recovery, but as I learned more about the nature of this virus, I'm trying to play it a little bit more safe and say we're going to probably have more of a U-shaped recovery, which is, a little slower comeback, because I'm thinking this could go a little bit into even the second quarter of the year. Hopefully not, but I'm still expecting a recovery that's pretty historical, but as fast as how quickly it comes back, that's maybe not as fast as we were hoping. And so the bottom line here is we are going to continue our neutral stance. If I were to get a lot more defensive right now, the market's already down quite a bit. It would be pretty bad timing. And certainly there's a lot of things that can pop up that can change the narrative very quickly on this, that could get better or maybe even worse. So that's why timing the market is just really a bad idea. It's best to just have a good asset allocation like what we have with a plan for rebalancing, etc. As we go through this volatility. But one of the things that I think you will start to see is I'm going to be starting to lean towards stocks, especially if the leading indicators continue to hold up. They have been actually very strong going into this. Of course, it's a little backward looking since a lot of this started happening in February. But we are going into this potential recession, which some people say could happen. We are going into it very, very strong. So I think we could probably weather it pretty well. So if we do hold up, I'll definitely be nibbling at some great deals that are available right now with the stock market. Thanks for listening. Okay, so here's the educational piece I wanted to review with you guys. Market corrections versus bear markets. The big thing I wanted you to take from this is that this happens. What we've seen over the last 12 years or so is an anomaly of not having a bear market and very few corrections. But a correction, again, is anything more than 10% of a drop from the previous high. And what happens is at a bear market, you get over 20%. Okay, so that's where those definitions come from. The frequency of a market correction is about once a year, and bear markets are about 3.4 years on average when they happen. And how long does it last? Usually 3 to 4 months on a market correction to 10 months in a bear market. So when bears show up, it usually lasts a little bit longer. The average loss for a market correction is about 13%. So we're right around in that average loss right now. So we'll have to see how things develop. But we're right around there for right now. The average bear market is much worse, more in the 35% loss. So that's a little bit more than double of where we are today. The worst loss, of course, goes to 20%. That's by definition then a bear market. And in the bear market back in 1931, the worst was 62%, which would be pretty horrible. And of course, on the market correction, the smallest is 10% by definition and 21% in a bear market. So this is another interesting one, is the average time it takes to recover the losses. So 3 to 4 months to recover the losses from a market correction, or 22 months for a bear market. And, when can this happen? Market corrections can happen really for any reason at all. There really doesn't have to be a lot of rationale behind it. Sometimes people just sell, because the prices are a little high. Bear markets, though, usually has more of a fundamental driver, recession. We saw the subprime lending, bubbles, market exuberance and valuations, high interest rates, things like that. So we're not quite there yet. This obviously this coronavirus could start to trigger some fundamental reasons for the market to take a hit, but usually there needs to be another shoe to drop before that really happens. So until that happens, I'm still looking at this as more of just a bad market correction due to mostly the fears with the coronavirus. And lastly, I want to leave you with a little inspiration. Comes from the Psalms. David, he was always hiding from King Saul, so he had a lot of time to reflect and write some verses here in the Bible. But I love this one. The Lord is my rock, my fortress, and my deliverer. And the thoughts here is speak these words over the cause of your fear. So if it's coronavirus, for example, the Lord is my rock, my fortress, and my deliverer. God is our hiding place. We weren't saved and redeemed only to limp through life riddled with fear and anxiety. So hang in there, guys. Remember, God's always with you. He's our rock, and this too shall pass. And I want to let everybody know to just be careful out there. Wash your hands. We want to be courageous, but we don't want to be careless. So go about living your life, but just be careful out there. I don't want to hear about anybody getting sick. So I hope everybody does well. And thank you again for tuning in. And please give me a call if there's any questions. But until we see each other again, talk to you soon. Okay, as mentioned in my update, we talked about the global economy probably seeing a slowdown. Vanguard's base case scenario for coronavirus is about a 0.5 point drop in China's 2020 growth rate, which is pretty significant, but still not the end of the world. They are in the 6% range right now for their GDP. As you can see in the world, you're seeing a minus 0.15. Now, maybe it's going to be a little bit worse than that. I think this was done a couple weeks ago, so it could be a little bit worse. But we're still, not predicting everybody to go zero growth for the whole year. It's really more of an incremental drop, probably worse in the first quarter or two. Okay. All right, you heard me mention about how China is starting to stabilize a little bit. This chart shows the Chinese stock market, which is in the green, and the U.S. stock market, which is in the blue. And what I want to point here to is February 22, 23rd. That's when the South Korea, Italy, and Iran news really started to show up. With the growth in infections of coronavirus. You can see how the United States stock market really took a big plunge there. China took a little bit of a hit there too, but they've been holding up much better. This chart doesn't go into March, but we've seen again kind of a similar trend. They have been taking little dings here and there, but it definitely hasn't been as bad as in the U.S., and it does look like maybe they're starting to stabilize. Here's my Econ Pi leading indicators chart that I show all the time. You can see here the red is the medium of all coordinates, and it's that little red square which is actually in the expansion quadrant now. We've actually been getting lots of very good economic news. In fact, just today we had the employment numbers that had more than expected employment growth and good wage growth, good participation rate, and also had the unemployment rate go down again. And so I mentioned earlier that we're going into this issue pretty strong. So this is as of the end of February, of course. So this is all stuff that's before the coronavirus. And so, of course, this is probably all going to get a little bit worse. How much is the question? And can we withstand a lot of it since we're going into it in so much strength? Okay? Okay, I thought this would be a helpful chart to show everybody, show the bright side of things. Whenever we get market corrections of 10% or more, historically what has happened is after a 1-year period, we get a return of about 11.3% on average, 10.2 after 3 years, and 9.6 annualized, of course, for 5 years. And so typically when the market is down and seeing some negative headlines, it's usually a pretty good opportunity, especially if you got a long-term mindset. Now, things don't always bounce back. It's not an automatic thing. But as you can see here, on average, the numbers do look pretty good for those who are patient, maybe even are opportunistic during these times. And I also talked about the sentiment getting very negative. This is one that I like to look at from time to time. It's called the Fear and Greed Index that CNN.com publishes. And as you can see right now, it's showing a -9, or I should say 9, which is lower than it's been in quite a while. They actually have a chart too that goes back a couple of years. And you can see that it hasn't been this low since basically back in December of 2018 when things were pretty much at the bottom of the market there about a year or so ago. So maybe things are bottoming. It is kind of an optimistic way to look at it. It can mean that things are just really, really bad, but the way I look at it, especially since there's some history at this point where things are bottoming, is maybe it's a good sign.